Hi, everyone. I'm Angela Giroux, publisher of the Bauman Letter. And joining me, of course, are Ted Bauman and Clint Lee, our experts. Now, Bauman Daily recommendations are up big time. Just to give you some examples, we are seeing 162% on ETF PBW, 128% on GAMR, 119% on TAN, and 104% on index fund QCLN. Now, those are really outstanding gains, but of course, along with those gains come questions. What do I do? Do I close out my position? Do I take profits? When is a good time to take profits? And it's actually a great question. And it brings up an important point because at Bauman Daily, this is a free e-letter that we send out. We give general recommendations like ETFs, like index funds, and we don't formally track them. We don't have a model portfolio. Our Bauman Letter, our monthly newsletter, our elite VIP research, such as Profit Switch, Flashpoint Fortunes. Now, we update those portfolios to the minute, but this is a little bit different. So today, I am going to ask Ted and Clint to share some strategies on exactly what you should do. When is it time to close these things out? When is it time to take profit? So 4 ways that you can know this and use this for yourself. So Ted, I'm going to start with you. And let's talk about regular profit taking, because I know it's sort of a cornerstone of the strategies that you use in your research services.
Yeah. No, I think that before we talk about the actual model that I'm going to show you a profit taking, the important thing to remember is that there's really 2 ways you can approach investing in general. One is that you ride the whole stock all the way up and you just take all the risk that's involved in the fact that the stock may pull back or whatever. And sure, you can make really huge gains, but you can also lose a lot of money because these days with the volatility we face, stocks are going haywire. Also, because a lot of popular stocks tend to be in growth mode, they are momentum-driven stocks that companies maybe not even making money yet. They can be extremely volatile and they can pull back quickly. So if you want to make money, in other words, if you want to minimize your risk and make money the safe way, the logical thing to do is to take profits regularly. And I've got a model here I want to show that shows taking 50% profits regularly. So basically, or rather, taking profits regularly every time the stock rises 50% above the previous time that you took profits, if that makes sense. So let's say you bought 100 shares of something at $100. So you spent $10,000. Now, when that stock price goes up to 150, that's a 50% gain in the price. At that point, if you wanted to sell back to your original value of your investment, sell back to $10,000, you'd sell 33 shares. So you'd end up with a profit of $5,000. The next time the stock goes up 50% to $225 a share, you sell 22 of those shares and you get down to $10,000 again. You've made another $5,000 profit. And you keep doing this essentially until you've got to the point where your holding is down to a point where you're comfortable to sell the whole stock. I've assumed that that's at 6 shares. And at that point, you've made $50,000 profit, a 404% return. Now, you can see that if you held the stock all the way through, potentially you would have made a higher return. But the point is here that in between these 50% gains, you could have 50% down periods. But you've locked in your 50% already. So if it goes down again and you wait for it to come back up again, that's how you're going to make money. There's no guarantee that bottom line return, of the straight line stock going up is going to happen because stocks never go up in a straight line. So taking regular profits is the secret, I think, to actually making money in a volatile market.
All right. Now, Clint is our technical guy. I know you tend to look at things a little bit differently. What's another strategy on the technical side that somebody could use if they don't know if it's time to sell? It'd be a good indicator.
Yeah, so with technical analysis, there's a lot of tools you can use to build a system around when to take profits or just to close out of a position entirely. And probably using moving averages is the most popular example. And I'll give you one instance here. You mentioned ticker PBW. It's a clean energy ETF earlier. I'll show a chart right here of PBW going back about 9 months or so. And the black line on here is a 50-day moving average. So that's a very popular moving average to use to, once again, you could use this as either a cross below that line is a profit-taking opportunity or to just close out of a position entirely. And a lot of investors pay attention to this, and you can see that that leads to something like this being a good indicator of support as well. We came down and tested that 50-day moving average 3 different times over this period. Now, this recommendation was originally made back in July, on July 10th. So using this 50-day moving average, you would have stayed in PBW this entire time, capturing those 160% plus gains up to this point. But I also know, something like PBW and the renewable energy space, there's a lot of volatility in that space. There's a lot of concerns in general about the state of the markets right now and where we're at. And so people, investors might not want to use something like the 50-day. That starts to become a longer term kind of buy and hold. If you look at where we're at right now, we're at $121 on this ETF. You would need to see it drop below $105 to trigger that sell. So you're giving up a lot of upside. So what you can do is just tighten and shorten those time frames. So I want to show another chart. This is still PBW, the exact same time frame, except I'm going to bring in a couple different indicators now. So the black line is still the 50-day moving average, but this purple line is a 20-day moving average. So just tightening up these moving averages, you can still use a cross below as sort of that signal to take profits or get out. But then when you start looking at building a system, you want to overlay this with other things. You can overlay this with other things to generate signals, like the MACD in this box below. This just shows how moving average momentum is picking up or slowing down. And what I'm showing is on the arrows on the MACD chart, that's when that momentum slowing, that actually coincided with PBW dipping below that 20-day moving average. So just a sign to get out. But if you also want to take sort of that trader's mentality approach to this, there's opportunities where you could have gotten out, but then you get back in. There's at least 3 different times on this chart where I'm highlighting these resistance patterns with the green trend lines on here. A break above those coincided with a turn back up in that MACD indicator as a sign to get back in. So yeah, it's a question of when to sell, but we've talked about this ETF several times now, and so you can start looking at trading opportunities on that. And I know Ted's actually got some comments on using something like resistance and support to help make these decisions as well.
Yeah, I think that, it's one way of doing what Clint is referring to is to look at when stocks break below a previous resistance level and when they rise, a previous support level and when they rise above a previous resistance level. Now, a support level is basically the level at which the stock price tends to go back up again if it's been falling. So the market wants that price to be the bottom price. A resistance level is when the stock hits a top price and then bounces back down again. The market wants that stock to stay below that price. So those 2 types of prices are ones that you can use to get a picture of where a stock is moving. Now, here's a chart that shows the silver ETF. It's in the news lately. Now, we recommended this stock on the 21st of December when it was trading inside that range. That green box shows the resistance level at the top and the support level at the bottom. Now, here's where sometimes setting up an automatic profit taking would make sense. Let's say that you bought that stock back in August, okay, that ETF back in August. You might have sent a stop loss at around $20.50. That would have basically prevented you from losing more money, but you wouldn't have made a profit. Now, if you bought that stock later on, let's say you bought it in October, setting a stop loss at 20.50 would have also protected your losses. But the key thing is that what we're really looking at is when that stock takes off in December. That's when we bought it. It goes up, right? So at that point, the question is, when do I sell? Well, you see that it bounces off that sort of 26.60 level, 26.50, and then falls back down again. And then, in fact, earlier this week, the week that we recorded this, SLV jumped above resistance. Now, at that point, you have a breakout, and we think that that becomes the new support level. So you should feel comfortable going ahead and buying it and setting the what is currently the upper resistance level as your new support level and setting a stop loss there. Now, stop losses in this case would have, they wouldn't have worked very well if you had bought the stock in August and then had it go down again. But there's another way you can do it, and that is to use trailing stop losses. So, for example, if you had bought the stock let's say right at the beginning of August, when it had dipped down after a previous attempt at a breakout, you could put a trailing stop loss of, say, maybe 2-3%. So if the stock loses 2 or 3% on a day's trading, it automatically sells. And that way you lock in whatever profits you've already made. So that's a way to do it. So the key message here is look at the support levels. Buying near a support level is a good idea, because that means that the stock is not likely to fall below it. When it bounces up above a level, you can take profits, but you can also then enter again, to set up a new resistance level.
All right, now, Clint, obviously there's not any one size fits all solution for any investor or really for any portfolio. But let's take a close look at GAMR, because that's been in the news lately. It's up big time. What strategy might you use to know, is this ride over? Should I take my profits? What's going on here?
Yeah, well, to one point you just made a second ago about there's not a one size fits all approach. That's very important for any investor to consider. There's a lot of times you're being pushed to be a long-term investor using maybe a long-term moving average like we talked about before, but your personality, your mentality, how you want to approach it, doesn't align with that. So you got to figure out, what approach works for you, the approach that you can stick to, and maintain discipline. That's the one where you're going to be the most successful. Now, with something like, GameStop's actually having a big impact on some gaming ETFs out there. GAMR is one of them. And this is a great example of, and I'll show a daily chart right here just to highlight that volatility we're seeing recently. This is actually one we recommended in April of last year. And then you can see we've had this really nice run up. But now all of a sudden, this increase in volatility, these big daily swings. And so that's why when I'm looking at a lot of these ETFs or individual stocks, it's looking at different time frames. Don't just focus on what's happening in the daily chart. When you look at this chart right here, there's a lot of, I call it noise. There's a lot of noise in this chart. And one of the ways you can eliminate the noise is just to switch a time frame. So this is the 1 year chart of GAMR, but here's the same 1 year chart, but instead of using daily prices, we use weekly information. So where it opened during the week, where it closed on Friday, and then everything that happened in between is captured on this chart. And when I'm looking at something like this, I can start to see more discernible trends in the data. I can start to see, kind of toward the end of 2020, some resistance around $70 that, Ted was talking about how to use resistance levels earlier. So those trends start to become more clear, but then, here's something I learned very early on in my trading career. I was just absolutely fixated on following these daily charts. I would have a stop in mind. I would get stopped out, and then you would immediately see during the week the price rebound at some point. So for me, when I'm taking a position, especially one that's maybe not as speculative, I'll rely on using a weekly chart like this, and I'll make my decisions based on where we end up at on Friday. I'll ignore everything else that's really happening during the week, because you can see volatility over those shorter time frames. But then to use the weekly close, using something with like a 10-day moving average on here or a 10-period moving average is the purple line. A weekly close below that being your signal ultimately to get out or take profits. There's a lot of value in lengthening out those time frames there.
And one thing to add there is that to be able to see this weekly and versus daily, most brokerages, if you click on a holding that you have, you go to the charting function, they will allow, you can click on a button that says switch between daily and weekly views. So it's really easy to do. Fidelity does it, E-Trade does it. Almost all the brokerages do it. So you can see these things fairly easily. And I think that the critical thing Clint pointed out was, if you take that longer term view, when you look at a weekly close below the moving average, that's maybe a signal to sell, because that means that the stock is showing weakness. But it could also mean that you might want to just take that money, hang in there, and wait for the stock to bounce back up again, and then buy back into it. So a lot of the the strategy here, particularly going back to the first one that I mentioned about taking profits, it doesn't mean you can't buy back into the stock. If that stock falls, like if GAMR falls or SLV falls or PBW, any of them fall, you've taken your profits. You can then go back and buy that position again at a lower price and make even more money. So the critical thing is, all it requires is that you pay attention and have a disciplined way to get out at certain times, but you don't have to stay out. And I think that's the critical thing.
Well, thank you both. It's important to keep in mind that profits are great for bragging rights, but until it's actually money in your account, they don't do you much good. So,
it's just numbers on it. It's numbers on a screen, folks, until you sell. And I think that's the thing.
Exactly. So I'm sure this was helpful. If anyone watching has additional questions, please feel free to email us at baumanletter@banyanhill.com. Until then, I will see you soon, gentlemen.
Thank you.
Thank you.